In April, rumors of Foxconn's exodus from China and its move to India sent stock prices in China and Hong Kong tumbling. Data indicate that during the 5 trading days starting April 23rd, over 3.17 billion in foreign capital fled China through the Shanghai-Hong Kong Stock Connect mechanism, amounting to more than 21 billion RMB. This marked the longest capital withdrawal streak since November last year. On April 24th, Foxconn officially announced its investment in India through the Hong Kong Stock Exchange, a move that will inevitably diminish its investment in China and impact millions of jobs in mainland China. Consequently, the Chinese and Hong Kong stock markets experienced notable fluctuations that day, with a broad market decline breaking expectations. Market panic led to a drop in both China and Hong Kong stock indices, with the Shanghai Composite Index falling below 3,000 and the ChiNext Index hitting a new low. Trading volume in both markets surpassed 1 trillion for 15 consecutive days after falling for 4 straight days, with a net outflow of 4 billion in foreign capital. On April 24th, Foxconn's fully owned subsidiary, Foxconn Interconnect Technology, issued a profit warning, causing its stock price to plummet. The highest decline reached 13.48%, closing at 1.55 Hong Kong dollars. Typically, such moves by a physical company indicate short, heavy losses and preparation for capital withdrawal. This development caused the entire Hong Kong stock market to fluctuate, with all stocks, including red chips and gold, declining on April 24th. Foxconn Interconnect Technology estimated on April 24th that net loss from continuing operations for the first quarter would range between 5 million and 10 million, compared to a net profit of 30.6 million for the same period last year. The loss is attributed to the group's investment in digital transformation, which involves moving from mainland China to India and incurring additional costs. Foxconn's management costs in China are relatively high, including stability maintenance costs and expatriate executive costs. Taiwanese executives are reluctant to work in mainland China for a fear of arrest. Last summer, worker unrest at Foxconn's Zhengzhou factory led to police being beaten and fences being torn down. However, there were no consequences, which is quite peculiar. Insiders revealed that the Chinese government's aggressive stance has caused Foxconn's Chinese factories to fail in obtaining orders from the United States. Although Foxconn plans to withdraw its investment, the Chinese government says it cannot leave or measures will be taken. Additionally, Foxconn's financial statements show a decline in cumulative shipments for the first quarter, implying a lack of orders for factories in mainland China, and thus Foxconn is cautious about its performance in the second and third quarters, suggesting that it cannot continue to operate in China. Foxconn's withdrawal from China will have significant repercussions. Foxconn has multiple divisions in China, directly employing millions of workers and creating a ripple effect in upstream and downstream industries. Even if Foxconn withdraws half of its operations, it would still result in millions of Chinese people losing their jobs. If the United States and the West continue to impose sanctions, Foxconn's production lines in mainland China will be unable to receive orders, and cooperation with China will face an uncertain future. The announcement also revealed that Foxconn Interconnect Technology is preparing to purchase 186.7 acres of land in Hyderabad in the state of Telangana in India at a proposed price of 23.8 million for the construction of a new factory, research and development center, and dormitories to facilitate the overall relocation. Foxconn Interconnect Technology holds as much as 71.38% of Foxconn's shares in India. On April 25th, China's stock market performed poorly, with a large number of stocks plummeting. Wind financial data showed that on that day, 38 billion RMB in reverse repurchase expired, injecting liquidity into the market, and the central bank had a net input of 132 billion RMB. However, the Shanghai and Shenzhen stock markets opened low and continued to decline, with the three major A-share indices falling for the fifth consecutive day. The Shanghai Composite Index fell 0.32% to close at 3,264.87 points. The Shenzhen Component Index fell 1.48% to close at 11,149 points, and the ChiNext Index fell 1.83%. That day marked the 16th consecutive trading day, with trading volume exceeding 1 trillion, with more than 4,200 stocks falling and a net outflow of 5 billion in foreign capital continuing. On April 26, in the morning session of the Shanghai Stock Exchange, Foxconn Industrial Internet fell again to close at 16.65 RMB, with a turnover of more than 27 billion RMB and tens of billions fled the market. Most of FII's shares are held by its Taiwanese parent company. Since its listing, the company's performance has been mediocre. Recently, with the help of artificial intelligence, FII has experienced a surge in popularity, and its stock price has risen rapidly within a short month. Subsequently, large sellers appeared, causing significant fluctuations in the stock price. On the afternoon of April 19th, FII's stock price plummeted and closed at the daily limit, with a market value of over 300 billion RMB. The Dragon and Tiger list data showed that more than 5 billion RMB worth of stocks were traded that day, with a net sale of 0.2 billion RMB. At the same time, the Stock Connect data showed a sell-off of 426 million RMB. These figures all indicate that capital is flowing out. The recent turmoil in the stock market, triggered by Foxconn's announcement and accompanied by the reported outflow of 3.1 billion within a mere 5 days, signifies a deepening erosion of foreign investors' confidence in the Chinese mainland market. As early as 14 years ago, renowned international corporations had already identified the deteriorating business environment in mainland China and initiated their withdrawal. In 2009, Nike shut down its Seoul factory in Taicang, China. In 2010, Philips divested its television business to TPV Technology, while Panasonic offloaded Sanyo's white goods division to Haier. In 2011, Nestlé shuttered its ice cream factory in Shanghai and retreated from the Huadong market, while German energy company RWE closed its Balto factory and exited the Chinese market altogether. Electrolux inked an agreement with GOM to shut down its factory and outsource production, and Google likewise withdrew from the Chinese market. In 2012, Lufthansa ended its joint venture, Jade Cargo International, in China, and Adidas closed its last remaining factory in the country. In 2013, Panasonic shut its Shanghai factory and Toshiba ceased operations at its Dalian television factory. In 2014, the world's largest generic drug conglomerate, Actavis, withdrew from China, and Panasonic relocated washing machine and microwave oven production from China to Shizuoka, Japan. In 2015, Microsoft terminated its Nokia factory in China, and Samsung shifted its Chinese factories to Southeast Asia. In 2016, Samsung supplier Atos halted production, Philips Lighting closed its Shenzhen factory, and Yum Brands sold Yum China to Primavera Capital Group and Ant Financial for $460 million. In 2017, McDonald's divested its Chinese operations to a joint venture between CITIC and Carlyle Group, which encompassed 2,500 McDonald's restaurants in China and 240 in Hong Kong. Nikon closed its Chinese camera factory, Mead Johnson shut its Shanghai facility, and Seagate ceased operations at its Suzhou plant. In 2018, Suzuki withdrew from Changhe Automobile, Nitto Denko closed its Suzhou factory, and Apple commenced the process of shifting production capacity out of China. In 2019, Samsung shuttered its final factory in Huizhou, Ricoh relocated its copier production line to Thailand, and Carrefour sold its supermarket business to Suning. In 2020, British supermarket chain Tesco announced its complete withdrawal from the Chinese market, while Philips sold its household appliance business to investment firm Hillhouse Capital, exiting the Chinese home appliance market. US clothing retail brand Old Navy announced its departure from the Chinese market and closed all its offline and online stores in the country. In 2021, Toshiba closed its last factory in Dalian, with the future production capacity to be transferred to Vietnam and Japan. Yahoo China ceased providing Yahoo products and services to mainland China, and technology media outlet Engadget, owned by Yahoo, shut down its Chinese version. Japanese electronics manufacturer Oki closed its printer and copier production business in China, moving its printer production line to Thailand and returning some maintenance parts production to its Fukushima plant in Japan. In 2022, Apple released the iPhone 14 assembled in India. Canon closed its Zhuhai factory and exited China, shifting its production line back to Japan. South Korea's Lotte Group dissolved its Chinese headquarters, opting to increase investment in Southeast Asian countries and further expand its market presence in the region. In 2023, Sony completed the transfer of its camera production line from China, relocating its primary factory to Thailand. As we enter 2023, the exodus of foreign investment has become even more pronounced, with entire industry clusters departing from China. For instance, Dell announced plans last year stipulating that by 2024, all chips must be produced outside of China. By 2025, 60% of products supplied to the US market must be manufactured outside of China, and by 2027, this production should reach 100%. Following the proposal of these objectives, the entire upstream and downstream industry chains began withdrawing from China, prompting 20 major PCB companies to relocate to Thailand, along with a multitude of supporting factories. At present, the United States' reliance on Chinese products has reached an all-time low, with a marked reduction in the number of product categories, where Chinese goods hold a market share of over 40% in the American market. The migration of Chinese industries to other countries can be attributed to several factors. First and foremost, wages in Southeast Asia are substantially lower than those in China, averaging around one-third of the cost. Secondly, this shift enables companies to circumvent tariffs levied by the United States on Chinese goods. Lastly, political risk plays a role, as the Chinese government persistently broaches the subject of forcefully reunifying Taiwan, which poses significant risks to investments. The primary destinations for China's industrial relocation can be broadly categorized into 4 regions: ASEAN nations, India, South Korea, and Mexico. Labor-intensive orders are predominantly transferred to ASEAN countries and India, while orders for machinery, electromechanical equipment, and precision instruments are located between Southeast Asia and Mexico. In the wake of the pandemic, China's industrial migration to Southeast Asia and India continues unabated. Among the 4 ASEAN nations, Indonesia, Thailand, and Vietnam primarily absorb labor-intensive industries. In addition, Vietnam also takes on technologically advanced industries, such as precision instruments and machinery, as well as electromechanical equipment. Malaysia, on the other hand, mainly concentrates on the precision instrument sector.